Well, no matter how far away your retirement years may be, it's important for you to understand your superannuation now. And critical to this is the superannuation statement. Here to help us make sense of it is Morningstar's Manager of Communications, Philip Gray. Philip, thanks for coming in.
Thanks, Nicole.
Let's get to the basics, Philip. Why do we need to read the superannuation statement?
Nicole, I think one of the key reasons why people should read their superannuation statement carefully is it will help you understand why your super fund has performed the way that it has performed. So your fund manager will put in there, in most cases, some commentary about how the fund has performed over the year and why the fund has performed the way that it has. In a good year, for example, they should talk about how the assets in the fund, the shares and listed property securities and so forth, how they've performed. And in a bad year, and like the two we've just seen, the fund manager should also talk about why the fund has done badly in terms of what's driving the performance of the super fund, the combination of underlying asset classes that the fund is invested in. And I think this takes us on to one of the key points that I think we try and make here at Morningstar, which is about looking below the surface of any fund, including a superannuation fund, and understanding just what the fund does invest in terms of what the breakdown is between, for example, Australian shares, international shares, fixed interest in cash and so forth.
Now, Philip, I've heard some commentators suggest that because these last few years have been so grim, that people should just take the superannuation statement and pop it in the drawer. What do you think of that?
Yeah, Nicole, I've heard that too in a couple of instances. I think that kind of advice is probably well-meaning in the sense that it's probably designed to stop people from engaging in the kind of counterproductive behaviours that people sometimes do, panicky switch, for example, to a more conservative option. But I think it's probably not as helpful as encouraging people to engage with their super by really taking the time perhaps to sit down. I always say to people, look, sit down at night after you've had your dinner, maybe get some coffee, sit at the kitchen table, get your marker pen and maybe sit down for an hour or so with your super statement and just maybe highlight the key things that are of interest. There are a couple of things to look out for. One will be that commentary, for example, where the fund manager tells you what's been happening and why. I think another important thing to look for is to really look closely at what kinds of assets, in terms of the breakdown between shares and listed property and fixed interests and so forth, your super option has been invested in, because not only the performance over the last financial year of your fund, but also your fund's future performance is going to be driven by what we call that asset allocation, or that mixture of different kinds of assets.
So, Philip, if you just have the default option for your superannuation, is that a bad choice?
For most people, the default option is probably a good option, because that default option will be generally a balanced or a growth fund, which has a good mixture, a good spread of assets between shares, international shares, some listed property and some fixed interest. And in fact, what often happens when there is a pronounced fall in share markets is that people who are more heavily invested in options, more heavily invested in shares, obviously that translates through into the performance of their super fund. If you're invested in the default or balanced option, then you're more likely to have a greater proportion of fixed interest and cash in that fund, which should hold up the fund's returns relative to more aggressive growth options. I think the problem occurs when, if you're a younger person, for example, and you have a longer investment time horizon than, say, older people, for example, in their 50s or even late 40s, 50s, for example. If you're a younger person, say you're in your 20s or even your 30s, and you've realistically got a 30, 35, 40-year time horizon, then I think it's probably more in your interest to be investing a little more aggressively, a little more into the options which have higher weightings to shares and property, because those are the superannuation funds which are going to be able to grow the value of your retirement savings most over the longer term. Yes, they're going to have years here and there, sometimes even 2 years in a row, sometimes possibly 3 years in a row. Yes, they're going to have periods where they're going to suffer sharp reversals, because that's the nature of markets, that's the nature of cycles. But if you do have that long-term investment horizon, then I think you run the risk of under-saving for your retirement income if you choose a much more conservative option than is really appropriate to your age and your risk profile and your time horizon.
So what you're saying is it's really important for investors to understand assets and cycles.
Yes, absolutely, and I think that's another one of the key reasons why we suggest to people that they do pay close attention to what goes on in their superannuation. read the statement that your fund manager sends you every year. Possibly also do a bit more research in terms of the research and tools that are available on this website to find out more about the underlying investment managers who run your super, and how risky your super has been compared to other options, what the fees that you're paying for your superannuation are compared to similar kinds of funds.
Now, Philip, I've noticed that the superannuation statements have been looking a little bit more glamorous, lots of pretty pictures, a lot more commentary, and that the actual bottom line figures are probably in very small font these days.
Well, I think it's understandable perhaps that fund managers find some challenges in communicating the implications of those losses. I mean, no one likes to see that dreaded negative sign in front of their superannuation return. I think, though, that in some ways an environment where there are negative returns is actually an opportunity, and it's an opportunity for fund managers, it's an opportunity for investors, it's an opportunity for people who have superannuation to actually just spend the time and the effort to understand what's really going on, and to understand, as I said, we talked about the nature of cycles, we talked about how your return is being driven by the assets that you invest in.
Finally, Philip, do you sit down at the kitchen table with a cup of coffee and a highlighter with your super statement?
Nicole, it's very funny that you say that. I haven't received my superannuation statement yet, but when I do, I will be.